Hi, this is, of course, I'm Hugh Johnson. I'm the chairman of Hugh Johnson Advisors, and this is another rendition of Hugh's Market Minute. I want to welcome you all back, try to bring you up to date on what our thinking is about where we are in the current stock market economic interest rate cycle. Since the last time we talked, not much has changed. The performance of the financial markets is very consistent with the kind of performance you see in an ongoing bull market economic recovery, and that's also confirmed by the numbers we see on the monetary and economic side of things. Bank lending remains very robust. It's also the case that money growth, which is which we need to drive both the economy and the financial markets, remains very solid. And leading indicators for the economy are also continue to expand or rise, although they're not doing it as consistently or as evenly as we've seen in the past. So based on the performance of the financial markets and the performance of important monetary and economic variables, it would be our view that we have further to go in the current cycle, even though, as I mentioned the last time, this is very long as cycles go. We're at the 91-month mark for the bull market, the average in the post-war period being 57 months. We're also at the 88th month of the economic recovery, the average being 60 months during the post-war period. So it's important that we're on our toes and watching those financial market indicators and economic indicators to see if we see signs that tell us that we're near or at the end of a cycle and that we need to reduce our exposure to equities and perhaps increase our exposure to fixed income securities. We do not see that now. I think it's also important to add, as I've mentioned to you in the past, that although this is a very long cycle, there have been 3 in the post-war period. This is the 11th. There have been 10 previous to this. There have been 3 in the post-war period that were longer than this, 95 months, 98 months, and 111 months. So there's no reason this one can't go further. But it's very important at this stage that we watch very carefully. One of the big questions, of course, that we're facing right now is what will the Federal Reserve do? The Federal Reserve is currently meeting as I'm talking. This is September. The expectation is they will not raise interest rates or change interest rates at this meeting. There may be a surprise, but I don't think so. I think they're probably going to postpone any decision on interest rates, or they will not increase interest rates until perhaps their December meeting or after the election. The reason being is that 2 things. One, they pay very close attention, of course, to the rate of inflation, and when you look at consumer inflation, it remains very low. 1%, nowhere near their target, and so they'd like to see that move up before they start to raise interest rates. And also, the economic numbers for the third quarter, we'd expected them to rebound. We'd expected a fairly strong rebound in the third quarter. The numbers are not coming in quite as strong as expected. We start the quarter with a 3.6% estimate for third quarter growth for the U.S. economy. That's down now to 3%. And again, that's because the economic numbers in general, retail sales in particular, not particularly impressive or strong. I think the combination of fairly subdued inflation, less than expected economic activity or growth in the third quarter is likely to mean that the Federal Reserve is not going to raise interest rates at their meeting today, that they're likely to defer until later, and I think that might be December. And of course, after that, there'll be questions as to what they'll do when we move into 2017. Our expectation is that the pace of increases in interest rates will be there, but it'll be very gradual. So they might raise interest rates not only in December, but the next move might be in June. A lot of this is guesswork, and it all depends on the data that we see on an ongoing basis. But right now, I'd say we're shooting for December. I think the question everybody asks is, what does this have to do with our view about the financial markets as well as portfolio policy? And the answer to that question is not a whole lot. We have introduced our forecast for the Federal Reserve into all our models, as well as our expectation for interest rates. Our expectation is that interest rates are going to march in lockstep with the Federal Reserve policy and move gradually higher as we move through 2017. The real big question is not just interest rates, of course, it's earnings. Earnings have come in better than expected, but believe me, The growth rate of earnings, S&P 500 operating earnings, has now been very subdued and very unimpressive. Our expectation is that for 2016 we're going to have a down year of about 3% in S&P 500 operating earnings, and that will be followed by, in 2017, an up year, but not a particularly robust up year. The earnings numbers are going to get better quarter by quarter because energy earnings are going to start to look really good compared to, say, 2015 and 2016 as we move through 2017 in response to the rise we've seen in oil prices. But still, when all is said and done, when we get through 2017, I would be surprised if our earnings growth rate was anything more than 0.5% or 1%. So the combination of rising interest rates and very subdued earnings growth means that valuation is a real concern. It's hard to make the case for a big, significant move up in stock prices. What that means for us in portfolio policy is we're in no hurry to increase our exposure to equities. Yes, we have a higher than median exposure to equities, and that's because we have further to go in the current cycle, and that makes sense to us. But we're in no hurry to add to our current exposure to equities, and quite frankly, we'd like to add, but only add on weakness. In other words, when the entry point from a valuation point of view is lower than it currently is. We're currently around 21,040 or so in the S&P 500. Until we got down to 2050 in the S&P 500, which is about 4% below current levels, we're not going to get real excited. We wouldn't consider it a good entry point until we get down there, and that's where we might be looking to adding to portfolios. But right now, as I mentioned, we're in no hurry. There may be an outbreak of speculation characterized by the emotion of euphoria, and we could go higher, but we're fine. We're well positioned in that eventuality. And again, this is all going to be, entry points are going to be extremely important, but I would also add that patience, and we've got to continue to watch things as we move forward. One of the questions which I have been continuously asked is about tax policy of the two candidates for the presidency. I think it's fairly clear that both understand, I don't know if they're going to do anything about it, both understand that corporate tax rates in the U.S. are too high, 35%, the highest corporate tax rate in the world, that there should be something done to reduce taxes from that 35% level down towards the 15% level. The candidates differ on income taxes, personal income taxes. Hillary Clinton, as you know, wants higher tax rates, particularly on those that are in the higher tax brackets, a 5% surtax on those making $4 million and above. In addition, she's talking about changing the capital gains tax to increase the tax on capital gains in order to provide the revenues so that she can support some increased infrastructure spending. It's very unclear as to what the Trump plan is. Clearly, he wants to reduce corporate taxes, and he wants to do something about either reducing or at least holding the line on personal income taxes. We'll have a better idea as to we move into the election season, we get through the debates, as to what their tax plans are and what the impact is going to be on the economy. I think now, just generally speaking, everybody's got to make up their own mind, but I think the election of Hillary Clinton probably means more of the same, a continuation of the policies of the Obama administration, and of course Trump represents a significant change, and it might mean a little bit less stability or a little more volatility, but nevertheless significant change from Trump, less change from Hillary Clinton. It's going to be a tough election, and we're not going to try to tell you how to vote. Everybody has to vote their own conscience and how they see things going forward. Thanks very much for joining me, and we'll try to keep you up to date regularly on what we see going on in the financial markets. As you can tell from what I'm saying is that there's not a big change from the last time we got together. It's still kind of more of the same. We still see an ongoing bull market. We still are very concerned or somewhat concerned about valuation. We're about 2% overvalued. We're exercising some patience and in no hurry to add to portfolio positions in equities. So it's really more of the same, steady as she goes. But believe me, at this late stage, this very advanced stage in a bull market and an economic recovery, it's time for us to be on our toes looking for those signs that the cycle is going to end. Believe me, we're doing that on a day-by-day basis, and we know how important it is that if we were to see those signs and say we're going to have a bear market that's going to be accompanied by a recession, that we would have to preserve capital, and preserve capital primarily by reducing our exposure to equities. We don't see that now, but at the same time, we're watching very closely to see if we do start to see those signs, in which case we'll do something about it. As always, thank you very much for joining us. I really appreciate the confidence you continue to show in us, and we're working very hard to continue to deserve that confidence. Thanks again for joining us.